Hey, welcome back, everybody. This is Chris Karam with Finspire, Chief Investment Officer, going through with a special edition of our Focus on the Market series, a short one this time that talks specifically about cash and liquidity management. So let's jump into it. I wanted to preface this as the other side of the benefit, I should say, of rising interest rates. We've heard a lot about how rising interest rates has really impacted values of core fixed income. It's hurt the equity market, but there's a flip side to this, and that's managing cash and liquidity in this environment has not been this good in almost 2 decades. First, how we got here, 41-year trend downward in yields, whether it's 2-year yield, 10-year yield. We have experienced this, and this is really what caused the end of the bull market in bonds. But you can see here the tail end. Of course, this year we've seen 2-year yields pick up to 4.4%, the 10-year yield at 4.01%, which means it's inverted. And you can see this on different spots of the yield curve. If you look at from short maturities here to long maturities like 30-year bonds over on the right, I really want to focus on, we've seen yields move up from the quarter end, even from September 30th to today. But I want to focus on this part of the yield curve right here. You see the 2-year yield at 4.4, the 1-year yield, which is the next dot over, just behind it, just shy of that number. Even 6-month yields look attractive at almost 4%. And then the short-term yield that the Federal Reserve controls, short-term Fed funds rate is poised to move up another potentially 75 basis points on November 2nd, which could put even shorter-term yields up north of 4%. And that's why this opportunity is so pressing. To give you a sense of where we are historically since the Great Financial Crisis, yields, whether it's in treasuries, investment-grade corporate bonds, or high yield, is well above the 15-year average since 2009. So this is an opportunity, especially in the short end of the curve, that we haven't seen in quite some time. So how do we go about this? How do we go about managing cash and putting together a portfolio? Well, we start with your objectives. What is the balance between your liquidity needs, your capital preservation desires, and the amount that you want to dedicate towards generating yield, whether it's in the form of maturities, 1 year, 2 year, 3 year, etc., or even go further out? Are there any income opportunities? Is there any value really at risk that you want to put in the portfolio in order to generate those yields, those attractive yields that we just saw a moment ago? And is there a strategy or a desire for longer term growth? Do you have cash on hand that you want to, say, rotate the interest and the interest from bonds into maybe an equity market as it slowly progresses higher? All those things are on the table. Everybody's a little bit different, but we take a look at the capital markets backdrop, make sure we optimize a portfolio that is ideal and tailored to your fit, and then, of course, manage ongoing and provide you with those updates and take any advantage of future opportunities. So if interest rates move higher again, we can plow a little bit of cash into those even higher yields, lock in certain yields that are very attractive, and as yields come back down, the value of those portfolios just rise over time. And so the opportunity is in the present. We're here to help you. We'd love to talk to you about how you're managing your cash and liquidity needs, and we will be reaching out to you to discuss shortly. Thanks so much for listening. Really appreciate it, and we'll see you next time.